Hello and welcome to Talk of the Boat. I'm your host, Robert Yazbek with Team Yazbek at Coldwell Banker here in Steamboat Springs, Colorado. Today we are going to do a deep dive into interest rates with the wildly successful and incredibly knowledgeable Kathryn Pedersen of Cross Country Mortgage. Kathryn, thank you for being here for the second time, and we appreciate your time.
Absolutely. Always good to be here. Always fun to do.
Welcome back. So let's jump right in.
Okay.
Rates have obviously been a little nutty this year since about May? Can you explain why rates have gone up so much this year?
Yeah, really, it kind of started with a whole bunch of things that happened during COVID and that were inflationary in nature. So we knew it was going to come. And of course, we always say, rates are going to go up, rates are going to go up. Well, they went up.
Yep.
So what happens is inflation greatly impacts interest rates. And the reason is because if I loan you $1 and inflation is high, when you pay me back the dollar in 30 years or, over time, I'm not going to be able to buy the same pack of gum that I could buy when I loaned it out. So in general, interest rates have to move when inflation moves up. So really that's been what's going on is we've seen high inflation and that has increased rates. Also, the Fed did purchase mortgage bonds for a very long time to keep interest rates artificially low, and they have slowed down those purchases or stopped the purchases to let the balance sheet, to let them kind of fall off of the balance sheet, and that has also increased rates at the same time. So we have really both of those factors going on, and that has definitely impacted interest rates.
No question.
Yes.
Great explanation. I love the metaphor too.
Thanks.
That's awesome. So how often can rates change?
So really all day, every day. It's an open mortgage bond market, just like the stock market, and mortgage rates are based on mortgage bonds. So your 401k is trading mortgage bonds, your most investments, foreign countries, all of that. So it's an open market depending on what's being announced and what's happening out there in the world. So technically, they can be different between 8 a.m. and 3 p.m. or 8 and noon, depending on just how quickly those price sheets change. So at least every day, if not more often.
Sure. And the fact that it's gone up so much in, short amount of time, not a big surprise, right? I mean, the fact that the artificial rates were so low and inflation went so crazy, I mean, I'm surprised they're not higher.
Yeah.
Right?
Yeah.
Would you agree? I mean, what wasn't a huge shock?
Yeah, other than that markets don't deal well with huge changes. So that's, I think, what's been the hardest is just to kind of stomach it. But yes, overall, it could have been more. And really, the Fed should have started their side of things by increasing the Fed funds rate, not different than a mortgage rate, earlier to help out with inflation. If they would have done that, we might not be in the position that we are in now.
Right. So talking about it for so long and then finally doing it, if they'd slowly started doing it, right? Yeah, makes sense. So perfect segue. When I hear that the Fed has changed the Fed funds rate, what does that mean? And does that mean mortgage rates went up the same amount?
I can almost predict my phone calls based on what the Fed does and what they say. And oh my gosh, rates are going to go up tomorrow, right? Totally different. So the Fed funds rate is the short-term overnight rate, and they increase it to pull money out essentially. Then commercial loans don't happen as often because rates are higher. Therefore, companies aren't spending as much money. So it's a way to kind of slow down things in the economy. And that is not a mortgage rate. So what happens is a lot of times if the Fed comes out and says, hey, we're increasing the Fed funds rate because we want to get inflation under control, my mortgage rates go down. Now, it depends on what they say and it depends on how long they go down. When they moved them down in June, my rates went down for like 2 weeks after that. So they're kind of related because depending on what they say will change things. But my rates do not jump 0.75% when Jerome Powell and the Fed increases Fed funds rate.
Right. But sometimes they do go up together, right? Just not in direct correlation.
It can. Yeah. It all comes down to why are they increasing or decreasing the Fed funds rate? What do they say at the press conference after that? And how does the market feel that they're doing with controlling inflation or helping out the economy?
Right. And sometimes interest rates will go up kind of ahead of, the Fed funds rate even changing just based on the news.
Yes.
Correct?
Yes.
And then sometimes When you expect it to go up after they've changed it, it doesn't necessarily go up.
Right.
So
right. So typically what will happen is the Fed bases their decision on all the economic reports that we see all the time.
Mm-hmm.
So a lot of times what's happening day by day is impacting mortgage rates day by day, depending on the announcements that are going on that week. You know, what's CPI? What's the jobs report?
Mm-hmm.
What is ADP? What are all those things that are going on in the world that impact those rates?
Mm-hmm. Where the Fed funds rate is just one factor of what affects mortgage rates.
Mm-hmm. Exactly. But boy, does my phone ring.
Yeah. I believe it. That's good, really good information, good education. It's been, really interesting to watch, and we get a lot of the same questions. So definitely good clarity. So kind of down to, I'm a buyer, and considering what's going on here, how does interest rate impact what I can qualify for?
So really, every time the interest rate goes up, the payment goes up, math. And when the payment goes up, what you can afford goes down a little bit, because we look at what's the percentage of your payment based on your income.
Right.
So that does hurt affordability, and we have seen affordability get impacted by the increase in mortgage rates.
No question.
So absolutely, it does make a difference for people.
Mm-hmm.
Now, the good news is that we've seen is with interest rates coming up, that has been really helpful for buyers. And this sounds weird, but what's happened is people are a little bit nervous, which is fine because it's kicked out some people from the market. Some people can't buy because of affordability, and therefore buyers who can qualify are able to get homes under contract. So we've actually had some buyers who were like, yes, now I can do this, and I have financing, and I only have 5% down, but guess what? My offer gets accepted.
Yeah.
So it's actually opened up the market for a lot of people.
Nice. And sellers are a little bit nervous too because of what's happened. So many buyers have gotten kicked out of the market, right? So there's more deals out there. Certain sellers are willing to negotiate a little more as well.
Exactly.
Yeah. So buyer in today's market, should I wait to buy?
So here's what I would say. If you're comfortable with the payment and you need a place to live, it's a good time to buy.
Right.
Because rents went up 15% year over year. Nationwide.
Crazy.
So you're going to pay it one way or the other. And the other thing is you can always refinance. So the common term out there in mortgage worlds, we hear it a million times, is date the rate, marry the house.
Yeah.
Divorce the rents. Like another one I've heard. So,
nice.
So those are the things that we try to kind of coach them on of, hey, we most likely are going to get an opportunity down the road to refinance. But when rates come down, guess what's going to happen? We're going to have a ton more buyers come into the market again because they've been waiting for interest rates to drop. Versus if you can get a house now and then refinance, let's say refinancing costs, $3,000 to $5,000. Well, most likely the house has gone up more than $3,000 to $5,000 in that time.
Right.
So you're still going to be ahead.
Nice. That's really good advice. Wait for the rate to go down to refinance, not to join every other buyer to get back in the market. Right?
Exactly.
Yeah, that's brilliant.
Exactly.
So what's your prediction for rates?
Whew. Did you bring that crystal ball?
Yes, we got polishing it now.
So overall, I would say that we expect rates to continue to increase, most likely for a good portion of this year.
Sure.
Then we hopefully will see a dip late fourth quarter, early next year, sometime next year, depending on what all happens with the economy, the war, everything else going on. So, but we'll see. I do feel like rates will come down. It's just a matter of when. Do I think they're going to go down to 3? That would be lovely, but I don't think that's going to happen with the Fed not stepping back in.
Right.
So I do feel like we could see 4s again, though, in the next few years, and that would be super exciting.
And what they are right now, I mean, what are rates today?
Well, I can't tell you without knowing like 47 things
exactly.
about you.
Yes. Yeah. Right. Of course. But roughly 30-year mortgage right now.
You can say it.
5.5 to 6.
Anyway, they're higher. They're higher than they used to be.
Okay. But they're still historically low is what I'm saying, right? Like relatively rates are still really, really low.
Yes.
And we probably won't see 3 ever again unless there's another major disaster, pandemic, war, whatever.
Housing crisis.
Housing crisis, right?
Yeah.
Like whatever it is.
Yeah. So I think that overall rates on average, at least from the stats before, since the beginning of time, was around 7. So we're still below average. Is it higher than it has been? Yes. Is it higher than a whole generation of people has seen? Yes. But that's just because they were so low for so long.
Yeah.
So we're normalizing now, and that's okay.
Gotcha. What's the 7 is 100-year average or 50-year average or what?
Well, it's since they really had mortgage rates, which it was more developed in the 60s, 70s.
Okay.
Yeah.
So 50 years or so. Gotcha. Okay, good. Well, it's good to know that we think that they may come down in the future, so that date the rate, marry the house makes a lot of sense.
Yes.
Nice.
Yes.
All right. So what are some things that buyers can do to get a better rate, and why is my rate not the same as my neighbor's rate?
Good question. We actually get that question a lot. Well, that guy, anyway.
Yeah, right. My friend has a rate of 2.2. Yeah.
So obviously timing, right? Even if you locked in your interest rate a month ago, your rates, the rate's going to be different today. So those just timing things can be huge. But beyond that, higher credit score, more down, what type of property are you purchasing? Those things really help. What you can do if you're looking at a purchase down the road is to work on some things so that you get a better interest rate when you purchase.
Right.
So, meet with a mortgage person to say, hey, what can I do to build up my credit score? What can I do to lower my mortgage insurance cost? Because that's kind of like a rate. So those are all things that you can do in advance to get the best possible rate when the time comes. Because what's a bummer is when you come in, you're under contract. I'm like, if I had more time with you, I would have you pay this off, pay this down, open this, do this. So the earlier you can get on that stuff, the better.
Definitely. Right. You come in and rates just dropped, but you're not ready. Right. So you don't get to take advantage of the drop.
That's true.
Yeah. Good advice. All right. So this is one of my favorite things going on right now. What is a seller buy down and how can that impact sales price and payment?
All right. So I'm going to approach it from the seller side a little bit.
Okay.
So let's say there's a seller and they're like, I'm just not getting enough showings. I want to lower the price. Well, one of the things that can happen, maybe you look at it as a combination of two things, lowering the price a little bit and doing a seller credit. And what that means is the seller gives the buyer a certain amount of money to use to buy down the interest rates. And what that can mean is if you kind of look comparatively, it means more money in the seller's pocket, lower payment for the buyer, which is kind of a win-win. So we basically look at, okay, let's say max concessions is 3%. What does that do if we pump that in to buy down the interest rate? And what does that payment look like for the buyer? And now does it get in the buyer's range of affordability?
Right.
So it's a way to kind of get everybody off of the fence and make everybody happy all at the same time. So that's super exciting. Just to give you a quick example, I looked at this yesterday. And a 2% seller credit was about a 0.75% rate drop. And it's going to vary for everybody, but that just kind of gives you an idea.
Yeah.
So for them, it was a drop in the payment of about $90 because we were at a low purchase price.
Perfect. What was the purchase price on that one?
$250.
Okay.
Yeah.
So multiply that by 4 for the average, single family home price in Steamboat, and that it can be a big deal.
Big deal.
And now can that be initiated by the buyer or the seller?
Yes. Yeah. So I've seen it in listings. I've seen it where the seller or the buyer says, hey, instead we want the seller concession and here's seller what you get instead. Because if you lower your price by this much or that much, here you go.
Yeah.
So we can do all sorts of nerdy worksheets because the problem, the hardest thing is explaining it to everybody and getting everybody on the same page to show them it's a win-win.
Right.
And that's what we like to do. But the seller or the buyer can really propose that.
Yeah.
Or the agent.
Yeah, of course. Yeah. I think there's just a ton of magic in that. I don't think people realize how effective it can be, because a year ago, it was full price or over full price, right? So there was no negotiation, which made it not possible, basically, right? But now that property's just sitting on the market a little longer and some sellers are coming down on their price, all of a sudden there's a little bit of room that can be applied toward buying down a rate instead of just increasing or decreasing the purchase price.
Exactly.
That's key.
Yes.
It's really good. I think it's really important.
Yeah. And we run those kind of numbers a lot where we hear, hey, I want to ask for a credit instead of doing this low ball offer, you might be in a better spot and you might be more likely to get the house.
Right.
Because if you have two offers and one's going to net you $500,000 and one's going to net you $450,000, which one are you going to take? So we try to have buyers understand that, hey, you can still be at the same payment, but also get the house.
Right. That's awesome. Wonderful. Thank you so much for being here.
Absolutely. So good to be here.
Appreciate your time. Really good information and hopefully some good takeaways for people.
Yeah, absolutely. And any questions, always reach out to either one of us.
Excellent. Yeah. Thank you so much for joining us, and we'll see you next week. Thank you so much for joining us for another episode of Talk of the Boat. If you enjoy this content, please subscribe on whatever platform you're viewing, like, and share with somebody else you think might enjoy it. We'd really appreciate that. Also, if you have any real estate related questions that you'd like us to answer on the air, please send those to us by email, text, or direct message. And as always, if you have any real estate questions or needs that we can help you with, please reach out. Thank you.